Hello everyone, this is Juan Sarmiento and today is Friday, March the 31st. Okay, let's quickly review what we have now and see if there is any changes we need to make. Okay, when the stocks are moving up, you're looking for a move above the smiley face. When I refer to smiley face, it's just this line here, okay? Smiley face, okay? It's just a curve here, and the bottom of it is here, right? So when the stock is here or below, we need to do nothing. But if it is above, well, it's a good point, good time to start making changes. That is, if you don't have any other indication. Let's take a look at the chart here of above Adobe, and you say, well, okay, that looks really good. It may be here hitting a new high sometime soon, and I have certain confidence that it will remain there or go higher, so then I don't make any changes. Or you might say, well, I'm not really keen on technical analysis, or I don't understand it. Well, then it's not so hard to say, well, if the stock is moving up and you have it here above the smiley face, perhaps it is a good time to take some profits. So the first thing you need to do is make sure that this is real, that this is the current price, this middle line here, which is called the slice. So reset the slices to make sure that they're correct. Okay, this is the current price, and as you can see, it's below the smiley face, so I need to do nothing until it does move above 386. Why don't I do anything? Well, because if the stock goes down, it may land here and gives me maximum profit, or it may continue to go higher, and that will be next week. So right now, no need to do anything. Look at the current shorts. They are April, okay, April 21st. Take a look at the add simulated trades and take a quick look. When is the April 21st? Well, as you can see, that's 21 days from now. If this number was 6, then we need to do a rollover, okay? But if it is 21, forget it. If you decide you want to look at your trades every day, then you check that this number is expiration, closer to expiration. Okay, so the 6 is because it's a week to expiration, right? All right, 7, 6, all right? And so with 1 week to expiration, you should be doing the rollover. That's to be, remove the guessing game out of it, okay? Just do your analysis in a way that it is very, very objective. You don't need to make any other judgments. You can see that I keep my current price, and this is my current position. It cost me $8,765, which is this number times 100, okay? And this is, if I were to sell it today, how much I will get. All right, so then you go and know what is the difference between those two. You can hide the current position just in case you have already done some adjustments. These adjustments should be added to this resulting price, and then you can see, okay, I have made $320 with this trade, and to be honest, that helps me. If I had $5,000, I will consider myself lucky and close the position perhaps, or perhaps do a rollover, all right? But in this case, no, there's no need to do anything. So let's move on to AXP. Show all, and this is the current position without the guessing game again. You can see this is my current position. Okay, it's now delta positive. Delta positive, it means that I will make money when it goes up. If it is a little delta positive, less than 50 deltas, I'm fine. Because if the stock was to collapse, volatility would spike and compensate me for the apparent loss in deltas. You can see that I have 1, 2, 3, 4, 5 legs. and you can see that I have 4 long calls, 2 long puts, and then a lower strike price of 155. That's because the stock, when the stock was going down, I did a roll down, which means I sold 2 of my 180 puts and I bought this 155 puts, both at the same strike price. Okay, and that makes my trade a little delta positive. And now that the stock is moving up, you can see the chart. Okay, it bottomed out and now it's moving up a little bit. Okay, that's good. If I suspect that the stock was going to go down again, I don't have an indication of that. The stochastics are moving up, the TTM is moving up. I have absolutely no indication. It's moving into the Ichimoku cloud, and the only thing that concerns me is that it's going mostly sideways, but I'm not going to make that judgment based on that. It is the Ichimoku cloud is yellow, which means it's bullish. Okay, after this move here, the stock went up and down, doesn't matter. They beat expectations by no, they actually met expectations or went a little, but after earnings the stock went up, which suggests that there was some indication that they were going to be increasing their revenues, and then it's collapsed. Perhaps the revenue hope was evaporated. Okay, so what do I do with this? I'm going to leave it alone. 6th of April, hey, that's a week from now. Well, that means that I have 6 days to expiration. I have the possibility to roll over. All right, so what I'm going to do is I'm going to roll over the put side. Why? Because they're deep in the money. The stock is trading at 165 and my strike price is 180. The call is a different story. Okay, so let me start by doing the rollover on the put side. Analyze rolling. And I'm going to do one month from now. So April goes to May. May 5 sounds good. And look at that, it's going to give me 67 cents. That's money that comes back to me. Considering that 100, that will be $67 times 2, $134 is what I'm going to get with that. Confirm and send. What about the call side? Well, the call side I could do a rollover too. Analyze rolling. But I would have to pay for it. Let's see. Let's change this to May 5th. Yeah, I will get less for that. Yeah, you can do the rollover on the call, or you can say, well, it's so deep in the money, it's not like I'm going to be sorry that the stock rallied from here to 179, because they will be worthless come next week. So I'm going to leave the call alone, and then next week, close to expiration on Friday, when I'm going to be talking to you, if that stock is below 180, I can sell calls and leave that other call open until it expires within hours to go. But we'll think about it next week, right? That's what I'm saying. Because we are, in other words, my standard here is we're so far away from the strike price that call can be left alone. I'm not afraid that I'm going to be assigned or anything like that, because it's so low, it's out of the money completely. And then as I get closer, I could sell calls, more calls, leaving those calls to expire worthless. Keep that in mind for next week. Let's go to BP. Okay, BP. You can see that I have, oh, look at that. I already sold the put. And that's good. Okay, let me just look for it. I don't have it integrated here, so let me just show you. I have, you see that I have 13 puts. In my simulation here, I have 14 puts. So that means I sold a put because I thought the stock was really low. So I sold one of my puts, which it was in a good time. Okay, so I'm gonna go to the monitor tab, account statement, and go back, BP, 100 days. Now we're going to say trade history, and here I have my put, right? So let's analyze that. Analyze trade. Okay, so my new position, analyze trade, is without that extra put, so 13 puts. Okay, now let me just show you the calculator. Let's do it with calculator. You can do it with spreadsheet if you want. So my original price was 6.31. Okay, times 700, because I have 7 lots. See that? Just look at the 7 here. If they have 7, 7, and 14, 14, yeah, you can say times 700. That's my price, $4,417. I'm gonna clear my memory and add it there. But because I sold this one put at $525, I'm gonna subtract $525. That's my final for the new trade. This one adjusted here. But keep in mind that this is no longer a multiple of 7. Now that's a multiple of 1 because 13 is a prime number. Okay, so my original price after I sold that put is $38.92. So you can put that here. $38.92. That's correct? Yes. Okay, so the combination of these two trades, let me just hide that position, hide that simulation, hide the position, so I end up with a simulation. The combination of these two, meaning the original trades minus the put that I sold, gives me a P&L of $243.73 or thereabouts. That should be identical to the combination that I just did, $241.72. So then I can say goodbye to all that. This is my new trade, my new simulation, adjusted trade. And then I can say analyze the opposite to see my result. Okay, so if I were to sell, I would get $41.36 as opposed to the $38.92 that I invested for a profit of $244. Okay, now we have March 31st is my shorts, and today is March 31st. So time to do some adjustments here. We are in the plus. Okay, we have a profitable trade, so you have my permission to roll it over. The put is very close to, it's deep in the money. It's, well, not deep, but it's in the money. The stock is at my strike price is 40 and the stock is at 38. So I'm going to do the put side, roll over the put, analyze rolling, and I'm going to go from April to May the 5th. So I'm extending it to one more month. Hey, I did it the opposite, so they say analyze the opposite. So that I am selling the May 5th and I'm buying back the April 6th. I'm sorry, this is wrong. Let's do this. Analyze rolling. Let's start over. Analyze rolling. Because the March 30, that's what I'm buying, and I'm going to sell the May 5th. Yeah. Or you can say April 30, 28. Let's go with May 5th. That gives me $44. You can do that. That's a simple rollover. That means we're extending the life of my short. That's all it is. And by doing that, I'm collecting back the premium that I got. I'm paying it back, and I'm getting more premium with this 44 with a month to go. So let's do that and get $308 in debit. That should fill out. But what about the call? Is, well, we are 2 points. The stock is pretty flat at 0.01. If you were afraid that the stock will go in the next couple of hours to 40, you wouldn't do this. But I'm not afraid that that will happen. So I'm simply going to sell the call side, leaving this to expire worthless. This March 31st 40 call. So what are we going to do? Well, I'm going to sell 7. And because I have 14 calls, I'm going to sell 7. And I already have 7 shorts, add up to 14 shorts, but I have 14 long calls. They compensate each other, and that's okay. All I have to do is change this May to May 5th and get 58 cents with it. You see now that my chart is unlimited loss for the, well, not unlimited, but it's at some point we're going to lose. If the stock rallied strongly to 50, there will be a point in which it will go flat, but it will be a loss. I'm not worried because we're talking about a few minutes really before the market closes. Okay, so that was my call. It was added. That was easy because it's a single call. So I'm going to add that to my trade. Put it there, and then we can make the same arrangement, but I will do this a little later, which means we would integrate the 6 cents to the trade we have. 60 cents. How do I do that? Well, analyze trade. Well, we'll do this next week because we still have to see that call expire, and so that we can have a 0 value for it and then account for that better. For now, I'm not accounting for it, but this is what my trade looks like right now. Waiting for the put to roll over, and I'm going to stop here. We'll do the rest in our next session. If we could do it on Monday, but I'm just waiting for this 2 trades to fill. All right, we can adjust them right now. The credit is for the BP is fine, 44. I'm asking for 44, and the mark is 47, so that should fill. This one is 72. I'm asking for 72, and the stock is trading at 70, 72 and a half. Let's leave it some time. It might get filled shortly. Let's move on to CRM and go to the Analyze tab, show the position, and then again, we look at the same sort of analysis. First of all, I see this 195 call. That was a roll up. You can see we have 5 legs. We have 1, 2, 3, 4, 5 calls. We have 2 calls at 150, 2 calls negative at 150 short, and 2 long. So they cancel each other. This is the only one, this 95 here, and the stock is trading at 200. And you can see that it's above the smiley face, so we can take some profits. How would I do that? Well, I'm going to roll over this May 195 call to the 200 or even to 205 if I wanted to be more aggressive. Let's say analyze rolling, and I go selling that 95 call and buying a higher strike price. That way we take some money off the table, but we're not leaving some possibility that the stock might go higher. Okay, make sure that it's the same strike price, there you go. But I see my delta is not neutralized, it's 31.74. And I say, well, I think that the stock has gone up quite a lot, and I suspect it might come down. Well, yeah, or may not, who knows. But I say, I think I'm going to go a little higher, and that's a way to get my profits. Well, the 105 is not being traded, unfortunately, so I'm going to stick with the 200. Could we go to 210? That's probably too aggressive. Well, look at the deltas. I don't see it as aggressive. Is it possible that the stock will go to 210? Yeah, it's possible. Yeah, I think I want to take my money. That option is probably very, very low in price. Go to the Analyze tab. Let's look at the options here at Simulated Trades. Look for that May 19 call at 210. Here, the extrinsic value is $4, but the one that I'm selling is $7 of extrinsic, $7.50 of its extrinsic value. So I'm getting quite a bit. Okay, so I think I'm gonna leave it. Gonna do that. I mean, I'm gonna buy the 210. It's kind of far away from where we are right now, but who knows? Okay, so confirm and send. It's not that cheap though, but I want some money back. At $4, it's not that cheap, but the one I'm selling is for a $7.58. So let's leave it alone. Let's go to FedEx. Okay, FedEx, nothing to do here. April is the expiration. Yeah, no, let's move on to Google. Same thing, April 21st, that's way far from our current position. Look how I have the original trade, and what if I were to close? Hey, that's profitable right now, just became profitable. It's sort of moving up and down, as you can see. Okay, let's look at it this way. And we are losing 50 cents, but that will change. But in the bottom line here is April as the expiration, so I need to let it work. April 21st, we have 21 days to go. Then, this is a bit of a loser, but we have still 1 week to let it, 2 weeks really to expiration, but next week we'll have to make a decision whether to close it or to stay with it. Let's look at PA, that's Palo Alto, I always forget, Palo Alto Networks, and then you can see here that, yeah, it's profitable. And where is my slice? Very close to this smiley face here. Let's get closer. So we wanted it to move, let's say, to 205, and it's right now almost 200. Okay. And other than that, the dates are okay. We're getting there. Let's look at quick look at the chart. Yeah, that's a strong move. That's going to be very profitable if we let it ride. I think it's going to go higher. Use your channel analysis. That will be a good idea here, because I see a strong line here. Yeah, it just made a bottom there, bottom of the channel, and it's bouncing strongly today. And just remember to always look back. They beat expectation by a wide margin, and now it should be paying off, going higher. All right, I'm going to leave it alone. Let's go back to STX. Also moving strongly. Do your channel analysis, and then I say, I'm projecting that it's going to go to the top of the channel. Well, that would be a big move, wouldn't it? So that's very, very strong. Check your earnings. They beat expectations by a wide margin. So yeah, you would expect it to move higher. So let's go to the Analyze tab. And here we have April. That's next week. Okay, so we're going to do the same rollover. Start with a put. Leave the call alone. We will do the call next week. I did sell some puts here, so you can go to the monitor tab and account statement, and you can copy all this and then do the accounting that I did. Correct your original trade, give yourself some credits here, and come up with the final I want to stop here now, so we will be doing this next week, okay? So right now, all I want to do is do a rollover. So do the put. Is far away from the call, so I'm not worried about the call. Let's do the puts only. Analyze rolling, and then next week, that will be the two of them. So let's select only analyze rolling, only the put side. So we're gonna go a week from now, that will be May 5th, and then we'll get $1.35. That's quite a bit of money credit. Okay, if you want, you could even add an additional put. I'm not going to do that because we already have a high delta. Yeah, let's do that. Yeah. All right. And while we wait for all these trades to sort themselves out, I do have a potential trade here, and that is Oracle. I have FedEx already. Let me copy that. I don't think that's going to work. Give me just a second. This is a tricky situation. Let me just explain why. Okay, you see it says here buy. That's a trade that I just copied. This is a spot. Bought is when you already have it executed, so change that to buy. If you're ever going to cross this, it should be buy. Now when I copy this, it should show up, no problem. Not working. That's unfortunate. Well, let's create it. How is that? Let's go to Oracle. Analyze that. Add simulated trades. Enter Oracle. Let's go to the trade tab. You know that I have saved. Okay, that was the CRM field. Okay, let's go to August. We want to go to August. Why? Because June has 77 days to go. We want 90 or higher. Okay, what is the strike price? 90 will be good. So I click here and I said buy custom, and because I have created these templates, go back to my previous videos and just create a Gini trade, and then I say analyze trade, and that creates this trade. And you can see it's August and May. The May, is it 30 days to go or more? 42 days to go. I want to go to May 5th. So I need to change this May 5th. Why? Because I don't want any much more than 30 days to expiration. Okay, that should be my trade. Okay, we copy this trade and take it to its spreadsheet. Paste it there. Okay, you can see the price here, $18.20. All right, so that means that $18.20, we'll enter it here, times 100 times 1 gives me a cost of $1,820. My account is close to 100,000. It's, yeah, 98,742. So I'm going. My trade is going to be 10% of my account. So I'm going to do this, multiply it, let's say by 591. That's good. How about 6? That's too much. It's more than 10,000. That's more than 10% of my account. So I'm going to put 5. Okay. So I'm multiplying my trade 5 times. So I'm going to go over here and I said, okay, that needs to be 10, 10, 5 and 5. 5 and 5. Okay, now we go back to the trade and say, you can fill this out, all right, the dates of expiration. I'm not going to waste my time. But let's go straight to earnings expectations. Okay, expected versus real. Go to the chart, and here is the last time Oracle was traded. Here it says that it beat expectation. It was estimated 0.957, and let's put here 1.957, and the actual was actually better than that. Really? Sorry. Here, 0.957. Okay, not 1.9. Yeah, 0 here. And then we can say that the difference was 27.5. So that should be good. The company is doing great, right? So why is it gone down? Well, now it's going up. So that explains. Okay, now we're going to go analyze the volatility skew. Go to the Analyze tab. Look at here at the bottom, my prices. Those are my volatilities for each leg of the stock. So let's go and enter those numbers here. For the calls, back month, what is the volatility? 29.52. For the puts, back month, 23.02. What about the shorts? For the calls, 24.49, and for the shorts 22.38, and I'd say that's the difference is less than 3%, 2.835. So that's fine. The actual difference between this number and that number is less than 3. So that means that the skew is against me, but not substantially, not too much. All right, so now liquidity, that's easy to guesstimate. All you have to say is create duplicate, and you see the mid versus the natural. And that gives you an impression of how easy it is to get in and get out of the trade, and that's your liquidity. So I'm gonna put here 18.20 versus 18.67. My difference is 2.5. If that was 3, too much. If it's 2.5, that's fine. And finally, the current IV percentile. You go to the trade tab, scroll down, look at the current IV percentile, that's 9. And if it is less than 15, we're fine. So I'm going to put a 9 here. Great. So everything checks out. All my factors here are in green, and I say, let's go with it. So let's go to the Analyze tab, and we're going to enter this trade, confirm and send, make sure that it is less than 10,000 or 9,870. Yeah, it is less than that. So we're not spending more than 10% of our account, and we just wait until it gets filled. Now, my job is to make sure that all these trades get filled. And if the prices have changed, hey, you need to adjust this so that they get filled before the end of the day. I already make the decision that I want them filled, so I'm going to simply unlock them first. Okay. unlock them. Yeah. Let's reduce the price. You lower the price, your credit, all you care is that they get filled. The Oracle trade is 18.20. That's more than the mark, so that should be filled soon. Let's do the same for the STX. You can see that the mark was actually exactly right. The mid here is the same as my current price, so I can reduce it, let's say by 5 cents, something like that. And then I will keep an eye on all these trades until they get filled today. All right, there's 1, 2, 3, 4, and adjust them if they go. You see the STX, that's way below the current mark. That should get filled. All right, that's all for today. Thank you very much for joining me, and see you next time. Bye bye.